The US Supreme Court has reportedly ruled in a 6-3 decision that the president does not have authority under IEEPA to impose broad-based tariffs in the way they were structured. For years, tariffs were used as a strategic economic weapon. They reshaped global supply chains, increased costs for businesses, and altered geopolitical negotiations. The United States collected over $150 billion in tariff revenues during that period. Now, think about the scale of this. The US imports more than $3 trillion worth of goods every year. Even a small tariff percentage directly affects corporate margins. Nearly 40 to 45% of S&P 500 company revenues come from overseas. Global merchandise trade itself exceeds $25 trillion annually. So, when the largest economy in the world faces a largest reset on trade authority, this is not a minor technical issue, it is a macro event. Let's start with equities. Tariff function like a tax on imports. When tariff rise, input costs rise. Companies either absorb the cost, which hurt margins, or pass it on to customers, which affects demand. If tariff burdens are rolled back or legally constrained, import-heavy sectors like retail, auto, manufacturing, and consumer electronics could see margin relief. Multinational corporations that operate complex global supply chains may benefit from the improved predictability. Markets reward clarity. When policy becomes more stable and less unpredictable, valuation premiums often expand. But there is another side to the story. If refund liabilities or fiscal implications increase, government borrowings needs, bond yields may rise. Higher yields can pressure equity valuations, so while margins may improve, the bond market reaction will play a crucial role in determining how far equities can move. Now look at global equity markets. Export-driven economies closely track US trade policy. If trade friction reduces, global risk appetite improves. Emerging markets could see capital inflows. A smoother trade environment reduces uncertainty premiums embedded in global stocks. However, if the ruling triggers prolonged legal or political disputes, short-term volatility may rise before clarity settles in. Next, commodities. Tariffs have historically distorted pricing in steel, aluminum, and industrial metals. When barriers go up, domestic prices often disconnect from global benchmarks. Removing or legally restricting tariffs can normalize pricing structures. Industrial metals like copper often reflect global manufacturing expectations. If trade tension reduces, the manufacturing outlook improves, which can support base metals and energy demand. Gold sits at the intersection of risk sentiment and fiscal concerns. If the ruling reduces geopolitical uncertainty, safe haven demand may soften, but if fiscal strain rises due to refund pressures, inflation expectation could increase, supporting gold. So commodities may experience volatility before aligning with broader macro signals. Now let's move to bonds. The United States already carries more than $34 trillion in federal debt. Annual deficits remain elevated. If significant refund liabilities emerge, markets will question how that impacts fiscal sustainability. Increased borrowing needs could push yields higher. At the same time, smoother trade flows reduces supply chain friction, potentially lowering inflation pressures. Lower inflation is bond positive. So the bond market will weigh fiscal expansion against disinflationary efficiency gains. Currencies are another key area. Trade policy directly influences currency flows. Reduced trade barriers may strengthen export-oriented economies and improve capital allocations towards emerging markets. That could moderate US dollar strength. However, if fiscal uncertainty dominates, global capital may still seek the relative safety of the dollar. Currency markets will react to whichever narrative proves stronger, trade normalization or fiscal strain. Now let's discuss crypto. Crypto does not react to legal rulings directly. It reacts to liquidity, sentiment, and macro stability. If this ruling reduces policy unpredictability and improves risk appetite, Bitcoin and other digital assets may benefit. If fiscal pressures increase and long-term debt sustainability becomes a concern, that strengthens the narrative of decentralized hard assets. In both scenarios, crypto remains sensitive to low liquidity evolves. Zooming out, this ruling is about more than tariffs. It is about institutional checks and balances. Markets operate on confidence in policy durability, confidence in governance, and confidence in predictability. When executive authority is legally constrained, some investors interpret this as an institutional stability. Stability reduces risk premiums. Lower risk premiums support asset prices. But transitions create volatility. Anytime the rules of economic engagement shift, markets reprice. The trade war era reshaped global supply chains, companies diversified production bases, capital expenditure patterns changed. If the executive tariff power is legally limited going forward, future trade disputes may unfold differently. That influences corporate strategy, and corporate strategy drives capital allocation. Capital allocation drives markets. This is why this decision matters beyond headlines. Markets do not just move on data releases, they move on structural shifts in power and policy. When predictability improves, risk assets often respond positively. When fiscal concerns rise, bond markets react defensively. The interaction between those forces will define the next phase. Watch bond yields, watch the US dollar, watch industrial metals like copper. These indicators will reveal where capital is positioning. Less trade friction improves efficiency. Improved efficiency can strengthen margins. Strong margins support risk appetite, but physical implications introduce counter pressure. This tension between efficiency and fiscal sustainability is where the market narrative will form. This is not just a legal event, this is a macroeconomic signal. It is a reminder that law, policy, and capital markets are deeply interconnected. And when legal structures shift, liquidity eventually follows. Smart investors do not ignore structural changes, they study, because sometimes the most powerful market moves begin in a courtroom and not a trading floor.